thanks very much for coming along to this this session. We're going to be talking about focusing in on really on the principally the forward funding market and the development market in build to rent. And for those of you who were here this morning, there was an interesting session which Jason Hardman chaired on covering some of the issues like the impact of interest rate rises, that sort of thing on the build to rent sector. But I think one of the interesting points that was made in that was really that 75% of the money that's going into build to rent at the moment is going into development rather than existing assets. So what I wanted to do was really use this session to focus in a bit more detail about the development market and more particularly the forward funding market. And I've got a great range of experts to comment. So I'm starting with Hayley. I'll just ask the panel just to quickly introduce themselves and a little bit on their background in forward funding build to rent. Hayley.
Sure. I'm Hayley Holness, and I work for Lendlease. I'm head of acquisitions, which includes build to rent in the investment management business.
Adam Burney, I'm investment director at London Square, overseeing, as the title suggests, investments into the business, but with primarily focusing on build to rent and forward funding.
Hi everyone, I'm Tom Henry. I'm investment director at Legal & General Suburban Build to Rent. That's what we call single family housing. I've been working in sort of build to rent forward funding since 2012, sort of as investor since 2015.
Hi, I'm Andrew Screen. I'm head of residential capital markets at BNP Paribas Real Estate. I've been in build to rent for about 15 years and did my first build to rent kind of forward funding deal about 12 years ago. And I typically find people with lots of money and people with lots of development.
Great, thank you. But I've been very privileged to work with these guys all over the last sort of 10 years as the forward funding markets evolved particularly, and we've seen things move so rapidly in build to rent. And just for those, in case there's anyone who hasn't really been involved in forward funding before, just what we're talking about in the development sort of model where we mention forward funding, we're really looking there at a situation where, as an investor, you buy the land, then you pay the developer after you bought it to carry out the development for you, usually up to a maximum commitment. And the big issue is you're taking on more risk there as an investor than you would if you just buy a completed development. But to hand over to the panel, the first sort of question, I think for everyone, without going into the reasons yet, and we'll come back to predictions for next year, but Andrew, would you say that the forward funding market is currently stalled?
I'll give you an idea of where the money's at, and then you can kind of understand what the movement is in the direction of travel. So in about sort of May, June of this year, we saw a whole new fresh amount of money coming into the sector. So this is over and above the kind of opportunistic capital that was already in the sector and pension fund money. And this money came in primarily from investors that were previously in office market and retail market. And basically were looking to move into alternatives. In other words, basically the bed sector, typically built to rent being the larger kind of quantity. And that all kind of started happening in about May, June. To the extent of it was about £1 billion every 2 months. £1 billion every 2 weeks. Yep, coming in. New introductions, people looking for product, stating their kind of interest in coming in. And then the trust event happened. Yep. And what happened is basically economic uncertainty. And a lot of that money generally in the market is now on hold. So it's on about a 2 to 3 month hold at the moment because investors are trying to determine things like interest rates, what the cap rates are going to be. One investor turned around to me and said, what will my exit cap be in 5 years' time? Yep, good question. So I think as we get more certainty over the next particular month, that'll help a lot. But so in terms of stalled, I think we're kind of in a moment of reflection. That's probably the best way.
And Tom, from the there at Legal in General. Would you go along with that?
Yeah, no, I'd go along with a lot of it. I think probably I'm a car man, so has it stalled or is it doing something else? I think it's probably stalled, but no one's put the handbrake on, and it's still rolling a little bit, but it's not sort of motoring along at slightly above the speed limit like it perhaps was earlier on in the year. Pretty much when I went away on holiday in August, it was sort of doing one thing, and then September was a very different story. I think that kind of fits with what Andrew was saying about the sort of new injection of capital and interest, sort of at the middle point of the year, really. So we're still trying to do deals. I know others are, perhaps slightly fewer than we would have been when we sort of planned and budgeted for the whole year at the beginning. But it's not stopped. It's doing something that's not going at the same rate and not fully stopped.
But even before we had the little mini budget trust event, the market was sort of struggling, as I could see it, on a lot of deals around the construction pricing. First of all, we had construction price inflation. So I was going to pick up that really with Hayley and Adam, having looked at it from a sort of developer as well as investor sector. I mean, particularly if you're doing a forward funding deal, you want to know there's a fixed build price. And what were you seeing on construction cost inflation earlier on in the year? What was the impact of that? And were you starting to see things on pricing stabilise? Maybe Hayley, if you could sort of kick off.
Sure. I wouldn't say I saw things stabilize. I think cost inflation has been an issue for any development for a stretch now, and I think the macro uncertainty has not resolved itself, so that continues to be a headwind. There has been a lot of rental growth, though, which has helped to maintain viability until we had the unfortunate events of the autumn, I guess is probably the best way to put it, and which has sort of stretched viability further in terms of terminal yields and relative pricing of asset classes. So that has been a challenge, and making sure that you have a sort of appropriate counterparty, both in terms of a development counterparty if you're doing a forward funding, a reliable contractor, if that's sort of the contract that you're going with, have all become higher risk factors when you're sort of assessing opportunities.
Yeah, I mean, I suppose just to add to that, I think the inflation was a real challenge at the start of the year, there's no doubt about that, but we were in a beneficial position that you obviously had what was going on with either sales prices, but also, as you mentioned, Hayley, the rental growth. The challenge has obviously been as we've moved into this environment and the shock that was triggered by trusts. What I would say is just to pick up on the point about, because it's easy to be quite negative about where we are at the moment, but I think one thing that's been positive is with the new change of government, at least that's created some stability in the market, and current deals that were paused seem to be still going through. I think where there's the stall is more around new deals, and if you look back, we've had 2 or 3 years of really phenomenal investment volumes into the sector. It's the first 6 months of this year, for example. Savills were reporting £2.5 billion of investment into the sector, which was up on last year when it was under 2 billion, and that in itself was much higher than trend. So, I think you've got to look at these investors who are looking at it and thinking, we've only got 6 weeks till Christmas. This is a notoriously quiet part of the year anyway for new deals. And I think why would you do that when we've still got the uncertainty around the monetary and fiscal measures that are going to be introduced. Obviously, we'll see what happens tomorrow. So that's where I see the sort of stalling or pausing in the market as investors take stock. I think on the build side, I think there are some positives that, there were certain elements that were seeing significant inflation. Rebar seemed to be mentioned on a weekly basis at our place, particularly after everything that was going on in the Ukraine. More recently it's been bricks, but I think actually there are some signs that there's a bit more stability in construction costs. But I think nevertheless, since the downfall of Carillion, I think you've got to be absolutely doing your full DD on contractors and their procurement processes, and that's something which London Square as both developer and contractor We're absolutely happy to open our books on how we go about procuring our contracts, where we've got exposure to different subcontractors and how we manage that. And I think more than ever, that's absolutely critical. And I think, to be honest, I think since Carillion, I think long gone are the days where institutional investors are simply looking at a top-tier contractor with a really strong balance sheet, because you've really got to dig down into the detail of how they're procuring for your scheme and where they've got exposure elsewhere.
Coming back to the other element of pricing that you touched on, Andrew, in terms of the interest rates, how, from your perspective, how are people pricing in both the sort of interest rate increases and predicted increases, and also, as Hayley was making the point about the rental increases, how are they balancing the two, or are they not quite able to balance the two just yet?
Well, I think it's, to some extent, the rent increases have actually rescued the financial viability of transactions. So to give you an idea, last year, your kind of interest rate for development, so we're working that off basically a 3 to 4 year fixed rate. Yep. So all in, including the margin. So an all-in interest rate was somewhere between basically 4% and 5%, yeah, for construction development period. That same interest rate now, on a basically a 3 to 4 year, is about between 8 and 9%. So pretty much double. Now, to be fair, that's not on the total cost of the project, because you don't leverage up 100%, and that's not only a portion of that. But it is a significant kind of cost. So that's the number that actually keeps me awake at night, is actually interest costs. That's not rent inflation, because that'll happen. And to a large extent, it's not about yield shifts and those kind of things, which I can talk about as well. But it's really about how that interest rate looks in terms of construction costs. There's another important thing with interest rate as well. So you've kind of built out your project, so you've managed to fit all that cost of interest into the project. But now the point is you get to stabilization and you need to refinance. Now the problem is that you're refinancing, particularly now, at a rate that is almost double what it was a year ago on the refi. So what that means is, from an investor's perspective, is the debt finance is no longer accretive to your invest return. So where you were getting a 16% IRR, 18% IRR, levered IRR over 7 years, that is now dropping down to basically about a 10, 11. Now, if it's a 10, 11 on your equity, the question is, why are you using debt finance? It's costing you basically 9, 10% anyway. So some of the equity is actually looking at it now and saying, we could actually probably fund this all in equity. Having said that, there's actually quite a few debt funds that are coming into the market now because of those debt fund costs of about 8, 9%. That's actually a very good return for a first charge against a property from a risk perspective. So while there's more money coming in, interest rates, I think what sort of keeps me awake at night, like I say, is the government cranking up basically the debt rate, which will push up all of those interest rates, which will basically make the market sit there and go, hold on a minute, are these rates going up again? Or have we now stabilized? The market's looking for stabilization. So that was a very long answer to your very short question.
And Hayley, would you comment on that analysis? Have you got a similar analysis in your mind and where you're looking at the market?
In terms of interest rates, the main impact, well, one of the things that we're looking at when it comes to interest rates is how the risk-free rate impacts capital flows and allocations, right? So it's very difficult to keep the same hurdle rates for projects when you can make similar on lower risk investments, right, in the bond market and in even in equities, which look relatively good value for a lot of institutional clients. And so what we're seeing is more globally when you look at capital flows, and this isn't just in this sector or just in the UK, but you're seeing a reallocation of capital, a reversal of what's been happening for probably 15 years of capital back into equities and fixed income and away from real estate, which is going to have an impact on terminal yields and hurdle rates, right, for investing going forward. So that's sort of what we're really paying attention to in terms of trying to figure out where terminal yields will settle and what that sort of balancing figure is going forward.
The only thing that's positive about the hurdle rates, though, and there's no escaping that the cost of capital has increased, but at least we are in a sector which, there is still strong prospects for rental growth with the underlying supply and demand constraints of the UK housing market. And combined with that, we're able to capture it on a month, well, annualised, but on a monthly basis. Whereas I think the commercial sectors, where I think there will be an absolute reweighting of funds away from commercial real estate, at best they were able to capture rental growth on a 5-yearly basis, and that the impact of that is really now quite dramatic. And at worst, you've got a number of sectors that were going through significant structural changes, retail, offices, all of that hasn't disappeared. And even logistics, where huge amounts of rental growth were already priced into the yields that were being applied. And given the overexpansion in some areas of those logistics markets, it's a kind of a double whammy that they're getting hit by cost of capital, limited availability to capture that growth, but also that there was an overpricing of some of those assets as well. Whereas I think build to rent will be more resilient. I think if you look back at how those yields have performed in line with gilt rates, it's actually, the correlation isn't quite as strong as maybe certain other sectors. So I'm still reasonably positive about that, but yeah, there's no escaping the impact from.
Well, I had an interesting discussion with Martin Stragoff of DWS, who was due to be on the panel this afternoon, unfortunately couldn't make it at the last moment, but he represents a lot of German investors, and he was making the interesting point that on a standard basis, he doesn't expect the German investors to be really looking to be investing in this market for a while yet. But what he thought was going to make a difference was if we saw people enticing the investors, if the developer entices the investor by a bit of an additional profit share, for example. And I think traditionally the forward funding model has seen your developer sort of assume that you get to practical completion and then you get your profit payment at PC. And I think there's a potential. Is there the potential there really for investors to be saying, well, if we're going to forward fund in this uncertain market, we want to look at the profit being more back-end loaded towards stabilisation and participate in it. So I'd be interested, particularly from Andrew and Adam's perspective, do you think we're going to see a change in the balance in the way that forward funding deals are structured?
I think it's important to set out the kind of the ground. So if you have a look at, let's just take a deal that is, I'm going to go into some maths now, but it's important you understand that. If you've got a deal that's 100 million GDV value, built to rent, 10 million of that is profit, developer's profit, 10 million of that is land, and 80 million is development cost. So that's roughly how it kind of works out. Let's just say that the yield or capitalization rate was 4%. If that yield moves out 10%, in other words, goes from 4% to 4.4, that takes out 90% of that developer's profit. So it takes out almost all of that developer's profit, but still leaves the land value. If that yield goes out to 4.5, from 4 to 4.5, it takes out all of that developer's profit and 10% of the land value. 1 million goes off the land value. So what's important to understand is so everybody talks about built to rent yields moving out of 1%, and you can see it can't happen because there's just no flexibility. So you've got that 25 basis points to 50 basis points. What's important to understand is that when an investor looks at a deal and they've got all these costs and volatility, they don't want to underwrite the deal including the developer's profit because they'll have to pay out that profit. So what they want to be able to do is turn around and say, I'll underwrite this deal without the profit, and if the numbers work out in terms of rental increases and what have you, when we stabilise the asset, when it's fully built up and stabilised, then I will pay you out your profit if the actual outturn number is higher than the original underwrite, and I'll maybe give you 50% or 25% of the upside over and above that. So the developer's rewarded for the profit he's kind of put at risk, in effect. But that way the investor understands that he can still underwrite that deal in a volatile market, not knowing where the yield will be at stabilization or the rental will be at stabilization. And to give you an idea, if the rental increases by 10% and the yield moves up by 10%, we're all good. Yep. Developers' profits restored, and then you're going to turn around and say it's not affordable. But that's a different question. But actually the underlying land value and the rent can still be put into the equation. So we've seen a couple of those deals already happening. Sorry, Philip.
Yeah, I mean, I think it's really come to a meeting of minds, to be honest, between investors and developers. So I probably should have said at the start, but prior to joining London Square, I spent 15 years at Knight Frank telling developers, towards the end anyway, that they should really be entering into sort of promote arrangements, because actually, why would you sell at PC? You've got a vacant building, and actually there's some value that's being left on the table there, and they'd be better served having a more of a promote arrangement and selling once it's up and stabilised at a better yield, and maybe be able to benefit from some upside in the rental growth. Clearly, the rents were growing at modest sort of 3%, not at the sort of heady levels that we're seeing today. And that's what's led to developers now coming to the table and saying, I think over the summer, we're saying, actually, we want a piece of that. We know that we're suffering all these costs, and meanwhile, these investors are getting a bargain deal here and are going to really benefit from that, from enjoying that rental growth during the build. So we want a piece of that. That works very well for us. And the investors have always wanted, it was a big thing that Moda used to sell to the markets with what they were doing, that they were retained there, they had a long-term interest, they were developing the assets, but the investors were having a developer that wasn't just walking away and handing the keys over. So I think there is that meeting of minds, and it's something that certainly at London Square, obviously, we stamp our name on sites anyway, and what we're doing on the affordable side with Square Roots and what we're doing on our London Square Living is all about kind of having a long-term guardianship of those schemes. So it works for us, and I think more developers will definitely be going down that route now.
Tom, I'm interested in your perspective as well on particularly the single-family housing market and what you're seeing happening in that, and how that's comparing to sort of city centre apartments. What's your experience on these issues in that market?
So I was actually, like colleagues, more on the urban side until April last year. So I've kind of bet my career on single-family housing last year, and it's been a bit of a roller coaster actually, in a good way. The sort of first 8 months would be characterised by phenomenal, fairly ferocious competition. A lot of it sort of private equity, North American funded, very sort of aggressive on bidding, and actually it was very challenging to sort of execute acquisitions in the market. And I'd say probably much quicker and faster than urban build-to-rent yields moved in over the course of really the first half of this year. So that, and Adam and I get on, but when he talks about developers wanting some of the rental growth, I'm thinking that's fine, but offer 3.5% yield for anywhere in the south of England, it's sort of an interesting starting point for sharing risk. And I think where things are probably going to move to on the single-family housing side is less developers asking. That was the other thing. So developers are all saying, we need you to cover build cost inflation for the first half of the year. And to be honest, we spent quite a lot of time working on whether we could live with that, how we could manage that, how we could rationalise that. Because with every deal you were asked, and what are you going to do for us about build cost inflation? I'm now hearing we get that that's sort of our risk to price now, which is good, because it would have been quite a big change for me on the funding side, on the institutional side, to really allow anything on that rather than the fixed price. But at the same time, I am very sympathetic to the cost challenges that developers are facing, and I think there's been probably cases over the last 12 months where developers and contractors have lost money on perfectly sensible, particularly some of the high-rise build stuff. So I actually really like the idea of deals with more alignment. Forward fundings are just this horrible alignment from the start, really. You want the best product with the best specification for your price, and the other side is typically, reputations aside, looking to deliver the product as cheaply as possible. And those two things aren't always completely aligned. Whereas the kind of deals that Andrew and Adam are talking about I think provide much more alignment and therefore could be much more interesting. In the single-family housing world, whether the house builder industry is going to be interested in those deals, I guess we'll find out during the course of next year. I'm sure they will be, but in what quantity probably remains to be seen. I've seen more of those deals in the sort of propco developer world in the past. So I think now would be exactly the right time to be structuring deals that way in that world.
And is there a big difference in the way people generally structure the payment profile in a single-family housing forward funding as against an apartment build?
Yes, I think, some key differences which sort of surprised me a little bit when I first made the move over were probably around the sort of timing of payments, and in particular the profit payments. So with typical urban build-to-rent scheme that I've worked on over the years, you're sort of building it for 3 years, it's finished at the end, and only really at the end or very close to the end is it substantially de-risked. So it's, I think, well, all the deals I worked on urban build-to-rent, all of the profit was paid out post-PC, and when you've got every tick box item, warranty, sign-offs, etc. With single-family housing, we obviously need all the sign-offs and good paperwork as well, but you're basically getting homes in a 2 or 3 year build from month 7 onwards, so you can't withhold all the profit to the end. Well, you could if that was the relationship in the market, but it's not, and the profit tends to be paid out on the drip. So that was one of the big differences for me, and I've kind of got used to it, because effectively, as you get these handovers, sort of halfway through the development, half of the project is completely de-risked. You own it, you're insuring it, you're running it, you probably let it. So it's right that profit is typically paid out on the drip in that way. There's quite a few other differences as well. You've typically got, although this would be the same in Adam's deals at London Square, but the majority of deals I worked on urban, you'd have a developer and you'd have all the terms we'd negotiate with the developer in the DA, which you'd help us with, Andrew, and then you'd have a big build contract condition in there and a third-party contractor. Probably on over 50% of the deals, I was taking most of my comfort from that contractor covenant strength and all the things that you're talking about, all the discipline around not just have they got a big balance sheet, but how they're going to do things, how they're going to approach things, what changes they can make, the process for speaking to us about variations, etc. With national house builders, you don't really have the sort of double line. The developer and the contractor are one entity, so it's often one contract. And it's interesting, once you're into the deals, for reasons I understand, they start to think of themselves as a contractor. So things like LADs, the conversation is sort of, we're a contractor, so we should get extensions of time for everything.
It's interesting you mentioned the sort of covenant strength point, because I wanted to come back to something that Hayley had mentioned in terms of looking at this balance of covenant strength from both the developer and the contractor. When you're going into a forward funding deal, as an investor, clearly there's more risk. And there's this sort of balance there in terms of what comfort have you got from the developer and the contractor, and the sort of robustness of the building price underneath it. But do you think with the current difficulties in the market, do you think it's going to mean that only the strongest developers and the strongest contractors, or someone small who can tie up with somebody who's a really large covenant strength, is it only going to be the big people who can play successfully in the forward funding market now, Hayley?
Well, I never want to say only, but I think that there'll be a change in, as you're looking at the overall risk profile of an investment, it'll come to play a larger role in terms of thinking about what the downside risks are, right? So, I think it'll become just sort of a larger focus in terms of looking at how risky the overall profile of the investment is, but I wouldn't want to say only, right? I think that would be a bit too extreme.
I'm conscious of the time, so I'm going to jump on a bit. Thanks, Hayley. But just sort of pick up on some top tips for this sector. We start off with you, Andrew. Predictions for the market in 2023, and tips that you would give to a developer or an investor looking at forward funding?
Okay, for 2023, I think that yields will move out probably about 25 basis points. But I think for prime locations, I think they're relatively stable because it's difficult to get those locations, particularly London-based locations. In terms of rents, I think rents are going to increase by 5 to 10%, more towards the 10 for London, and the same for 24, yep. Which will offset some of those kind of costs involved. In terms of our top tips, I mean, what we're seeing at the moment is we're seeing more kind of programmatic joint ventures from developers. So those developers, instead of going the forward funding route, would like to tie in with an equity partner for multiple deals, gives them certainty over capital, particularly over the next 2 to 3 years, and how they can bind into those relationships now. So we've been approached by 3 developers in the last 2 months to do exactly that. Covenant strength is very important, as you mentioned. In terms of actually the top tips, I think, particularly at the moment, as particularly for developers, is be flexible. Those structures are going to change. Next year is going to be volatile. It's going to get crazy, but there's going to be lots of opportunity to actually get into deals. There's going to be land deals that are falling apart because they were debt financed. But actually, I think money is going to be moving next year, so that equity is going to be placed. There's a lot of equity chasing the sector. So I think we're going to see quite an active year, but it's going to be different.
Tom, your thoughts?
I don't want to be too negative. I don't really like competition, so I try and put everyone else off. But I think 2023 probably won't immediately provide all the solutions. I think we're sort of moving into an era where there's going to be plenty more questions, and that's going to throw up its own challenges. I think the pricing of debt. I mean, debt does 2 things. It's accretive, or it's not at the moment, but it also allows you to buy more. And with debt being more expensive, less is going to trade because the capacity for the industry to buy is going to be smaller. So for that reason, plus a bit, some uncertainty that won't fully evaporate, I think there's going to be sort of lower volumes in 2023, personally. I'm okay with that because I think there's less competition from what I'm picking up, and so I think there might be a sort of equilibrium there, which is kind of worked. Despite not liking competition, I think advice for experienced investors is they probably won't listen to my advice. They'll have their own views. For new investors to the residential sector, I think next year will be almost certainly a buying opportunity if you're a long-term through-cycle investor, if you're not using too much gearing. It doesn't mean everything that comes your way will be a good buy, but I think it will be a buying opportunity in the longer term. And I think I would just probably stick to best quality and quality counterparties. So all the deal structuring and numbers looking good isn't going to help you if things really start to unravel. So quality locations and quality counterparties for the long term. I think the people will be doing business, but I think there'll be just less probably in terms of volumes in our market.
Yeah, I think just building on that, we've focused very much on the quality of one side of the counterparty, which being the kind of developer and contractor side. But I think building up on what the guys said, I think next year it's going to be cash is king because of where we are with debt, and I think really understanding the investor and their structures and equity-based investors will, I think, really dominate. And as Andrew said, for that reason, I think there'll be a flight to quality because those types of investors tend to be at the on the spectrum far more towards the institutional end of the market. I think just a slightly separate point in terms of tips. I think that some of the challenges that we were already encountering from a developer's perspective, in respect of ESG and fire safety and some of those requirements, they really haven't gone away, and they're not going to go away. These are long-term requirements, and it's a fundamental change in our market which hasn't disappeared. There's been a lot of focus on the financial side, but those things are still in place, and I think continuing to have a plan for that and a strategy is going to be absolutely critical, and even more so because, again, the types of investors that you really want to be working with next year.
Thanks. And Hayley, no pressure being providing the conclusion to the session, but particularly as you've got both the developer hat and the investor hat, combining the two, what are your thoughts and recommendations for next year?
Oh, I wouldn't make any recommendations as such at this stage. I don't have a crystal ball, but I do think that because I have the benefit of not only having to invest in one asset class or one jurisdiction, and I would still say that despite all of the headwinds, for the right opportunities, I think BTR is still my preferred asset class in terms of overall risk profile. There's a lot of potential risks out there as you look at sort of the medium term. But overall, I think when you're looking at the various property asset classes that you were going through, the fundamentals are probably the most sound.
Great. Well, thank you all very much for that. I think you allowed just enough time for a couple of questions if anyone has any questions. Straight away.
In terms of, we've heard an awful lot about the importance of rental growth, and I just wondered very quickly, what would it do to your models if the government introduces some form of rent control?
Shall I have no, you.
Yeah, well, no, that was one of the risks that I was sort of alluding to for the medium term, which is particularly if, I think that most betting people would assume Labour is going to be elected in a couple of years, and if rental growth continues at the pace that it currently has been, double-digit rental growth isn't really sustainable during a cost of living crisis. So I think it's a non-immaterial risk, and I think it would be dangerous to assume that the limited supply is going to allow for extremely heady rental growth. So you just need to be sensible in looking at the entire political reality, not just the supply-demand dynamics when you're doing your underwriting.
Anyone else got a view?
Yeah, I mean, I agree with that, and I think that if you think about the sort of most dramatic types of rent capping and things, I think that's it would be pretty detrimental to the prospects of attracting capital to the sector fairly obviously. I think there are sort of other smaller incremental measures that actually there's probably a lot of alignment between institutional build to rent and good policy around things like some sensible management of tenancies in tenancy so that people can stay and have their families and all that kind of stuff. I think that's all part of what we're doing in urban build to rent. So that sort of thing, and the removal of the no fault eviction ground and all that sort of thing doesn't really change the model too much. There are some markets in which in tenancy rents are fettered somewhat, and it's all about the mechanism and the detail. So how would it change the model? It depends on what the policy is. Generally speaking, for investors, the less meddling, the better. I think we probably all know that. If you look at what's happening in Scotland, just at the moment, it's whatever it is now is one thing, but it's kind of what might happen next becomes the sensible question for investors. So I think that's probably the key thing to keep an eye on is sort of does it start with something and then turn into something else?
I think basically rent caps will curb investment because investors don't want that extra complexity of having to deal with another bunch of regulation. That can be volatile. In Dublin, for instance, the rent cap was 4%. They then changed it to 2%. So as an investor, you're going, well, I've underwritten for 4%. Now I've suddenly got basically a 2% underwrite. Quite simple. If you want to actually reduce prices of rental, increase supply. Yep. Government needs to build more affordable and social housing because if you increase the overall supply, basically price comes down. Yep, simple as that. At the moment, what's happening is you've got massive demand. So by putting basically a cap on it, you're not actually changing the supply-demand dynamics. You're basically interfering with economics that are at present.
Well, on that, I'm told we have to end the session. I'm grateful to you all coming along, particularly grateful to the panel. I'm sure they'll be interested to share their views some more if you want to come and have a chat. But maybe if you join me in the usual way in thanking them for their participation this afternoon.